Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about first, today's US market review. Markets mask a hidden war as capital flees big tech. While the S&P 500 flatlines, a small cap surge signals a high stakes gamble on a Fed rate cut. Is this the turning point? Second, Detroit vs Tesla. Lifeline for GM and Ford masks a direct strike on Tesla's $2.76 billion profit engine. This policy reversal saves Detroit's truck profits, but a little-known clause is designed to kill Tesla's cash cow. Will it work? And will this hand the entire EV future to China? Finally, Meta's $70 billion Metaverse dream implodes, triggering an all-in pivot to an AI war. The market is rewarding Meta for killing its own vision, a critical turning point for all of big tech. But as one giant retreats, who is moving in to seize control? Markets are not just moving, they're on the cusp of transformation. With the Federal Reserve poised for a potential rate cut next week, the stakes couldn't be higher. The S&P 500 closed with a modest 0.1% gain, but don't let the calm deceive you beneath the surface. There's a seismic shift underway. The Russell 2000 0.8% surge signals an aggressive rotation into small caps and cyclicals, while tech giants like Intel and Amazon falter. I'm telling you, this is a critical moment act now, or risk being left behind. The S&P 500 isn't just tiptoeing around record highs, it's staring down a pivotal moment as we approach the December 10th FOMC meeting. The market's 80% confidence in a rate cut reflects a clear expectation of monetary accommodation. Yet the mixed labour signal's weak. ADP payrolls down 32,000 and a hefty 71,321 challenger layoffs suggest the labour market might be softening. For investors, this is the moment of truth. A rate cut could ignite a risk-on rally, while a hold would challenge the market's resilience. Let's break it down. The Fed is under pressure to act. Economic data paints a murky picture. While jobless claims hit a 3-year low of 191,000, suggesting resilience, the broader labour market looks shaky. The Fed's dovish signals, including New York Fed President John Williams' openness to a rate cut, have sent market expectations soaring. Bank of America and JP Morgan have shifted their forecasts, now favouring a December cut, and the CME FedWatch tool shows an 80% probability of a 25 basis point reduction. But here's the kicker. The Fed's summary of economic projections, set to release alongside the rate decision, could reshape market expectations for 2026. A dovish dot plot could trigger a broad rally, whereas a hawkish outlook might send shockwaves through equities. Capital is already on the move. We're seeing a defensive rotation with money flowing into small caps and cyclicals in anticipation of a rate cut. The Russell 2000's leadership, coupled with the financial sector's resilience, underscores this shift. Meanwhile, tech's flat performance masks underlying weaknesses. Investors are selectively trimming mega-cap tech positions, wary of their stretched valuations amid rising 10-year Treasury yields, which have climbed to 4.09%. Valuation bubbles are forming and bursting in real time. Intel's 7.5% plunge underscores the dangers of holding onto high valuation tech without fundamental support. Conversely, Meta's 3.4% rally on spending discipline shows that markets reward financial prudence. This is a classic pre-rate cut scenario. Small caps and cyclicals are poised to benefit from a lower cost of capital, while high multiple tech stocks face pressure. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. In the short term, 1 to 2 weeks, if Friday's PCE data shows inflation below 0.3%, act now to overweight small cap ETFs like IWM by 4 to 6% and increase financials with XLF by 2 to 3%. Target a broader cyclical exposure with XLI and XLB and trim tech by 2 to 3% if holding MSFT or Google. Medium term, 1 to 3 months, assuming the Fed cuts, maintain this overweight on cyclicals, but watch for the 10-year yield to rise above 4.5%, a clear signal to reassess risk. For risk control, set stop losses. If the Russell 2000 breaches 2,490, or if the Fed surprises with hawkish language, hedge with SPY, put options or increase cash to 10 to 15% for volatility protection. Sector-wise, today's winners are clear: financials and small caps. Dollar General's 12 to 14% leap on earnings reflects consumer pressure driving value, retail outperformance. Consider adding DG or discount retail ETFs. Meanwhile, tech's underperformance, specifically Intel's decline, signals a need for caution. Contrarian plays like Meta's rise are exceptions, driven by strategic shifts rather than broad tech strength. Watch for further tech weakness if the Fed disappoints. This is your last boarding chance. With the December 10th FOMC meeting as the inflection point, time's running out to position your portfolio. The key is flexibility. Prepare for both outcomes with tailored strategies for each Fed scenario. If the Fed cuts and signals more in 2026, maximize small cap and cyclical exposure. Conversely, if the dot plot disappoints, pivot quickly to defensive names like XLU and XLP. Now, let's dig into today's most important developments, including the specific stories driving this critical market dynamic. The finish line for America's auto industry just got moved. A major policy reversal just slashed the required fuel efficiency target for 2031 from an ambitious 50 miles per gallon down to just 34.5. US President Donald Trump announced the rollback of the Biden-era standards, calling the previous rules horrible for car costs and claiming they were making cars worse. This decision brings both potential savings on the sticker price and comes with the inherent risk of higher fuel costs down the line. The administration is focused on making new cars cheaper to buy right now, with the National Highway Traffic Safety Administration estimating savings for families on the initial purchase, but that creates a direct trade-off. The EPA had previously calculated that stricter standards would save consumers thousands in fuel costs over the life of the vehicle. So we might see a temporary dip in new car inflation, but households could end up paying more at the pump. The move was immediately celebrated by Ford's chief executive Jim Farley as a victory of common sense and aligned with customer demand. However, if you zoom out, you'll see another layer of strategy at play. For legacy automakers like GM, Ford, and Stellantis, this regulatory rollback is a lifeline. You see, their most profitable products are precisely the large, gasoline-powered trucks and SUVs that are the least fuel efficient. Building out EV capacity requires massive capital expenditure, and this policy change allows them to de-risk and slow down that expensive transition, protecting their short-term profits. We're already seeing signs of this, with some companies like Stellantis reportedly delaying the production of new electric truck models. It's a strategic choice. Secure today's profits, even if it means potentially ceding long-term EV market share. This rollback has ignited a firestorm. The previous plan was expected to prevent over 700 million metric tons of carbon dioxide emissions, and environmental groups like the Sierra Club are calling the decision a threat to public health. Now, here's where it gets interesting. The new proposal is also moving to end the program that allowed car makers to buy compliance credits from more efficient rivals, like Tesla. The administration claims that policy had artificially propped up the EV industry. Those credits have been an incredible high margin revenue stream for Tesla. In 2023, the company made $1.79 billion just from selling these regulatory credits. In 2024, that number jumped to a staggering $2.76 billion, almost pure profit. By eliminating this market, the administration is directly challenging Tesla's business model and testing whether it can be profitable without these subsidies. The debate pits two starkly different futures against each other, one built on aggressive EV adoption and another aligned with what automakers call current customer demand. With this move, the administration is placing a firm bet on the latter, and this bet has major global implications, especially with China. When we place the easing of US standards alongside China's aggressive state-backed promotion of its new energy vehicle industry, the contradiction becomes clear. China already accounts for about 65% of global EV sales, and projections suggest that by 2030, EVs could make up 80% of new car sales there versus less than 30% in the US. This policy could widen that competitive gap, making the US auto sector more vulnerable in the long run. So what does this all mean going forward? A less fuel-efficient American vehicle fleet creates a higher structural demand for gasoline. That makes the entire US economy more sensitive to global oil price shocks, which could complicate the Fed's inflation fight. The things to watch are the capital expenditure announcements from the big three to see if they're really slowing EV investment, and the monthly CPI report to see how this trade-off between sticker price and fuel cost plays out in the real world. Speaking of massive strategic bets and the long-term competition with China, another giant is making a historic pivot. We're moving from Detroit's auto industry to Silicon Valley, where Meta is facing a $70 billion reckoning. Believe it or not, Meta's Metaverse division has burned through over $70 billion in cumulative losses since late 2020. And now, after sinking that mountain of cash into its virtual reality dream, reports indicate CEO Mark Zuckerberg is planning to make significant cuts, potentially as high as 30% for the entire unit. And, this isn't just a Meta story. It's actually a signal of a broader trend across big tech where these huge speculative moonshot projects are facing a new era of austerity. After years of pouring money into far-off dreams, the focus is shifting back to capital discipline and near-term profitability. This is the same company that famously changed its name from Facebook to Meta in 2021. A move Zuckerberg said was because the metaverse is the next frontier. But the market's reaction to the potential cuts tells a completely different story. As the news broke, Meta's stock jumped 4%. What really brought this to a head was this huge shift in investor psychology. For years, visionary CEOs were rewarded with high stock prices for promising future growth. But that visionary premium is disappearing. The market's message is now clear. Investors prefer immediate, reliable profits over speculative, long-term gambles. The scale of the financial drain is staggering. The division, known as Reality Labs, reported a $4.4 billion loss in its most recent quarter alone. The proposed cuts, reportedly part of budget planning for 2026, would likely include layoffs and hit the company's virtual reality group hard. And of course, there's a very real human impact to these strategic shifts. This move is triggering a rapid structural change in the tech labor market, with layoffs in fields like VR, while hiring for AI talent accelerates. It's creating a skill mismatch that's putting pressure on wages as the workforce scrambles to realign. So the thing is, this isn't just about saving money. It's about reallocating it. Capital is essentially being cannibalized from the metaverse to be fed into the AI war. Meta's spending on AI infrastructure is projected to nearly double to over $70 billion. This creates a winner-take-all dynamic in AI, but it also risks creating billions of dollars in stranded assets, metaverse, hardware, software, and research that may now become obsolete. Looking ahead, the situation presents a fascinating duality, especially when we look at China. On one side, you have Meta, a pillar of the US private sector, retreating from building a hardware ecosystem for the metaverse. On the other, China's state-supported industrial policy is moving in the opposite direction, with plans for a national venture capital fund aiming to mobilize over $100 billion US dollars for high-tech sectors like VR and AR. A US private sector retreat from this hardware platform could cede long-term dominance of the next consumer device and its entire supply chain to Chinese firms. This is an ongoing focal point to watch.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.